Buy the dip is great advice in an uptrend. Every healthy bull market has pullbacks, and buying those pullbacks at the right time is one of the highest probability setups in trading. But the same instinct in a downtrend is how retail traders bleed out one knife at a time. Every red candle looks like opportunity, every bounce convinces you the bottom is in, and the position averages down until it's the whole portfolio. Today, the regime test that separates a healthy pullback from a real bear leg and the structural filter that keeps you from buying every dip the market gives you. Here's the test. Look at the last 3 to 5 swing highs and 3 to 5 swing lows on your time frame. Are the highs getting higher and the lows getting higher? That's an uptrend. Buy the dip is in play. Are the highs getting lower and the lows getting lower? That's a downtrend. Every dip is a continuation, not a bottom. The regime is the most important variable on the chart. Get it right and most setups work. Get it wrong and even good entries lose money. Watch this in a synthetic downtrend. Lower highs, lower lows, textbook bear structure. A retail trader sees the first dip and buys, treating it as a normal pullback. Price bounces briefly, then makes a new lower low. They buy again, averaging down, bounce, lower low, buy, lower low. By the end, they've bought 4 dips on the way down and they're sitting on a position that's down 20%. None of those dips were dips. They were the next leg of a downtrend the trader refused to acknowledge. Here's the key transition signal. When an uptrend ends, the first warning is a failed higher high. Price attempts a new high, fails, and reverses. The next warning is a lower low. Price breaks below the prior swing low instead of holding it. Once you see both a failed higher high and a subsequent lower low, the regime has flipped. Buy the dip is now off the table until structure flips back. Most traders ignore both signals and keep buying. The chart was telling them, they refused to listen. Now the real setup. Same dip mechanic but in a confirmed uptrend, clear higher highs, clear higher lows, structure intact. Price pulls back into a prior breakout level. The trader checks regime first, uptrend confirmed, checks the level, previous resistance now acting as support. Buys the dip with a stop below the recent swing low. This is the dip buy trade that works. The structure earned the entry, the trader didn't force it. On a real chart, scroll back to any major downtrend and trace the structure. Every dip was a continuation, not a bottom. Scroll back to any major uptrend and trace the structure. Every dip was an opportunity. The setup didn't change, the regime did. Make regime your first check on every trade idea. If structure is broken, the trade is wrong, no matter how good the entry pattern looks in isolation. So, buy the dip only works in uptrends defined by higher highs and higher lows. The moment structure flips to lower highs and lower lows, dips become continuations and the same instinct destroys accounts. Check regime before every entry. It's the single most important variable on the chart. Subscribe for the full method and trade your own plan. Education, not financial advice.